Welcome to today's session, the case for and against bundling. For those of you who I haven't met, my name's Justin Owen. I'm CEO and part founder of REI Master and EasyRes and our new product REI Cloud. I've been servicing the industry since 1999 and have grown this business to now service over 1,300 clients around Australia, which we're pretty proud of. We've got a great team, some of which you've met today. And I always take the time to thank those team members when we do a session like this because they do such a great job of supporting you. So we've got Scott Fitzsimmons, who's up the back here videoing today, who many of you would know his voice from support. And we've got Teresa up the back here, so welcome to both of those guys. Teresa's our business development manager and looks after all of our management changes and our new clients. REI Cloud is live. Some people would have seen me playing around with that before the session began today, so we're really thrilled about that. That's our new browser-based trust accounting program. We've got clients that are live and doing their end of months on that, so you're going to hear a lot of information from us about that over the coming weeks and months. I already talked about the car parks. For the toilets, they're located upstairs, just in behind the top of the stairwell. If everyone could please turn their phones on to silent or off, just as a courtesy to our presenter today. We've done a lot of these sessions and we understand that something always goes wrong for someone at their complex in the middle of a presentation. Okay, that's normal and we get it. So if you need to take a call, that's fine, just if you wouldn't mind taking that up the back or just outside and then come back in and join the session, it's no problem at all. We had a huge amount of interest in today's session, so we've got some empty seats, but they were in fact all booked. And because of that, we've got today's session being recorded and we're going to make that available on our YouTube site as well. A little bit about our panel. We've got two presenters today and tomorrow. Today being Damien, so welcome Damien.
Thank you.
Damian's been servicing our industry since 1998. He's very hands-on and is often referred to as not your typical accountant. The reason why is that he's got a great amount of actual hands-on business experience in businesses like yours. Combine that with the accounting experience that he's got from way back in 1988 through to now, it makes Damien really well placed to present today's session. So Damien's firm, Savvi Accounting, represents many clients with trust accounts and provides services from profit verification, audit, taxation, planning, superannuation, corporate structures and general accounting advice. Tomorrow we'll be welcoming Tony from Holman's, making his way down from the Sunshine Coast, so that's a really great effort for him. Tony's been servicing the industry for 20 years and specialised in accounting and taxation services to the accommodation industry. Tony's well known for being passionate about advising new entrants to the accommodation industry and getting them set up right from the beginning. And the Holman's team are currently servicing about 300 hotels, motels and management rights. So I think we'd all agree we've got some really great presenters today and for tomorrow as well. And we really thank them for giving up their time for what is really a topical issue at the moment. So just to get started, what is bundling? And generally bundling is the grouping of all of your, or a majority of your fees and services into one percentage amount that gets levied to your owners. Okay? So traditionally we might have a management commission and various other fees and charges that are levied against our owners. And bundling is the process of bringing that together into a much larger percentage amount that's levied as one fee or a series of lesser lines of fees to our owners on their owner statements, represented by a much higher percentage amount typically. I've been asked why split this session into 2 days. We've got some accountants here and accountants are always right? Our accountants are always right. And we wanted to give our accountants fresh air to present each of their points of view. They've got some compelling arguments as to why they're right. And they've got some really good information for us all over the next couple of days. But we didn't want to get into a session of Tony said this and Damien said that. Because their content has a high degree of value taken in context of how your business operates. And so I wanted to point that out from the beginning. Both of our presenters have the absolute utmost respect for each other and often will present at various sessions together. And this isn't a matter of who's going to be the winner. So we're not going to operate either of our sessions in that context. But there is a winner if you take the content and apply that to your business and actively make the right decision for your business. So that's the focus that we're going to have for today. So to bundle or not to bundle. Whenever we're doing a session like this, we're talking about making money. And we make money primarily from our owners. And we'll always remember with a session like this that the owners are at the core of what we do, and a partnership with our owners, a viable and ongoing partnership with our owners, it needs to be at the core of what we do. But without your business operating strongly and profitably, the owner's assets are at risk. And that's why it's so important to be inward looking to our businesses such as we are today, to get it right, to get the right structure for your business. Because property management's not a community service. We're here to make a profit and to be viable. And without that, the business just won't exist. Wanted everyone to have a think about the concept of value. And property management isn't property management. Okay? Think about it from the point of an entry-level car through to a luxury car. What is your concept of value? And how does that tie in with the cost of the fees and services that you're levying to your owners? And almost all of you have a much higher value concept than a traditional real estate agent who isn't operating on site, for example. So what's your value concept? So today is a chance to think about our ongoing profitability, our owner outcomes, changing market conditions, and that could include changes to the Act and regulations which occurred in December 2014, and the fact that we're undergoing a sustained period of low CPI and low wages growth, and the implications for selling as well. And as always, my important disclaimer that today's session is general in nature and does not consider your individual circumstances, and you should contact your accountant or professional advisor for information specific to your circumstances. So as I said, we will be recording today's session, and we'll also make the slides available for download from our website. And without too much more, I'll welcome Damien. Thanks, Damien.
Thank you. We'll just switch the presentations over from Justin's to mine, and then we'll get cracking. So I've just got my details on the screen. Each of you should have a card on your chair there. If you do have any questions at all today, feel free to ask them today. If you're a bit uncomfortable asking them in a crowd, I'll be around afterwards, or you can contact me on our contact details there if that's more appropriate for you. So my history: in December 1988, I started in the management rights industry as a trust account auditor. I was a trust account auditor for approximately 3.5 years, and Nikki from our team up the back here is our trust account auditor, some of you may know. Basically that gave me the grounding of the management rights industry. 3 years doing trust account audits, you really get a good understanding of what's going on in the industry. 1993 to 1995, I actually left the industry, and Justin mentioned that I had some real business experience, so to speak, other than just accounting. I left accounting and I went and sat on your side of the desk as a business owner, managed a large group of Brisbane hotels which my family owned, and that was interesting. I spent 2 years at the Browns Plains Hotel, which is a large pub in southwest Brisbane. My nose was a bit straighter than it is today. It's got a bit of a rough tag, that pub. But anyway, it gave me a really good insight into business and what you people deal with on a day-to-day basis as business owners. I then came back into the accounting space. 1996 and 1997 I spent in Noosa. and I set up a management rights specialty business in the accounting space up there during that period of time. 1998 until last year was the owner of Baker & Affleck Chartered Accountants, and we specialise in management rights to the industry, and this year have started Savvi Accounting with another partner. And I missed one thing there. During the GFC, one of the important things that we had to do was deal with receivers, unfortunately, for some of the larger developers and some of the larger management rights complexes. We were very involved in the largest hotel and management rights deals with the receivers and helping them to sell that. And that was pulling those businesses apart, working out how they can be profitable, and then putting them back together again, and obviously offering them for sale on the market. So one of the things you'll note in my presentation today is I'll talk about business drivers and the things that drive your business and make profit in your business. That's one of my key arguments for unbundling, is obviously having that transparency to be able to see the key drivers in your business. So my presentation is why stay unbundled, a smarter business model. Justin gave the disclaimer, but again, the information today, my opinion, and the conclusions from today's discussion are general in nature, not specific to your circumstances. If you do want specific advice, please don't hesitate to call. Only too happy to help you out. So let's get stuck into it. The things that we're going to discuss today, management rights, the business. Obviously, when you put your business owner's hat on, what are you looking at? And in the management rights business, why are you in business? A question many of you probably ask yourselves on a daily basis, particularly at present. And your business and your obligations. So obviously, as a business owner, you have certain obligations legally through ASIC and the Companies Act, which obviously you need to be aware of. Bundling and what is bundling and why should we bundle, etc., is part of my discussion. Obviously, briefly, Tony will get into that in more depth tomorrow. And what is the opposite of bundling? What does that look like? And that's where I'll spend a fair amount of my time. And why unbundle? So I'll be talking about those points throughout the presentation. Don't hesitate to ask questions. I'm more than happy to take questions from the floor. So if you feel like you need to say something, please go right ahead. So obviously, management rights, the business, what are we talking about? Obviously, you have certain assets of value in this industry. What are they? The first thing is obviously your body corporate and your relationship with the body corporate. Next, you have a group of owners in your letting pool, and you have a relationship with those people. They are an asset to your business. Then you have, and some of you may not consider these people assets, but certainly they are, owners which are non-letting pool. So your lockups, outside agents or owner-occupiers. Now they are assets of your business and you need to treat them that way to get the best out of your business and the relationship with the body corporate. The letting agreement obviously is a big asset of your business because it allows you to do what you do. And the caretaking agreement, again, sometimes they are combined in one agreement, admittedly, but often they are two agreements as well. That is really the key agreement in the key asset of your business. Without those things, you can't operate, you can't do the things you do. Now, that's a bit of paper. How is that such a valuable asset? Well, obviously, the things that it allows you to do, the business it allows you to have, and the restrictions it puts within that building for others to operate, obviously gives you a strong asset, hence what you do on a day-to-day basis. The POA agreements, obviously, they are a strong asset in your business as well. They are your agreements with the owners, and yes, while they can be terminated, obviously, while they are in existence, they are of value to you. So those things up on the board there are your business. That's what you buy, that's what you pay all this money for, and that's what you have to take care of. So in this whole process, when I'm going to talk about bundling and versus unbundling, we have to keep these things at the forefront of our mind, because that's our business and that's what is of value to us when we sell. Okay? Why are you in business? Are you in business? And I've been doing this for a long time, as I said, since 1988, so I've heard a lot of different opinions, from I'm buying this business to play golf 3 times a week, to I'm buying this business to as a stepping stone to a bigger business, all different types of things and reasons for people being in this business. So is it lifestyle, is it profit, or is it maybe both? Obviously you have to ask yourselves those questions, but really what I'm here to talk about today is the middle one, and that is profit. So we'll talk about profit predominantly when I'm dealing with this presentation. Now I've got a couple of different growth equations for your business that I've modelled. Can I just have a show of hands? How many here are in the short-term holiday space? Hands up. And hands up those of you who are in permanent space. Okay, so we've got a few on each side of the fence. So what I will do is I will cater for both of you. Oops. In what I'm going to show you now. So this is for short-term letting. So what we've done is broken down your business into the various components that drive the profit of your business. So on the top left, we've got existing customers, we've got a retention rate, so people coming back, obviously visiting again. Below that, we've got our marketing efforts, so our number of leads and our conversion rate, which gives us our new guests. Underneath that, in the middle of the screen, we've got transactions per year, how many times they might come and stay with you on a yearly basis, and an average transaction I've assumed in this instance a 2-day stay. That could be longer in your complex, it could be shorter, depending on what type of complex you operate. That obviously gives you the annual sales when you put all those different drivers together. I use this for different types of businesses as well. There's no real cost of goods sold in your business. However, I've obviously got expenses down in the bottom box there. So what I've done here is, in the blue boxes, I've given you a current scenario. In the green boxes, I've said if we do certain things within our business and try and improve these key drivers, this is the result that we might have. So in the first couple of boxes, existing customers, I've assumed 500 customers. That does say 500, doesn't it? I'm just about due a new prescription. Yes, it does. 500 customers at 75% retention rate. Now that means of those 500 customers, 375 of them are going to come back. Now you'd hope that's higher than that, wouldn't you? What could you do to make their experience better, to make them come back? Start to think along those sort of lines. Now, down one step, we're saying, well, we get 250 leads through our marketing, and 30% of those leads convert to people who come and stay. So that's 75 customers. And then we're saying 2 transactions per year, so they come twice a year. That's perhaps high. Maybe they come once a year. Some people will come more than twice a year. But let's just say for this purpose, it's twice a year. And we're saying it's a 2-night stay. We're saying the expenses are $205,000 for this particular business for the year. Now, you'll note in the average transaction box, the 2-night stay, I've assumed that at $450. So I'm saying $225 a night. Okay. So if we go back up to the top left, where I'm saying existing customers, well, we've still got 500 existing customers, but what if we did some things while those customers were staying with us that made more of them come back and stay. Now obviously you can think outside the box and think of some of the things that might help people coming back to you. If we just move that from 75% to 80% of them come back, that gives us an extra 25 people staying annually. So that come back annually. So that's, instead of 375, that's 400 people. Doesn't seem a lot when you put it in those numbers, but wait till the back end of this and I'll show you the value it makes to your business. Moving some of these key drivers just a little bit will give you a massive result. Number of leads, 250 at 30%, gives you 75 new customers a year. If we made those leads through our marketing efforts 300 and we stayed at 30%, so we're not doing anything more in terms of our sales ability or our conversion rate, we can influence that too by training people on our front desks. We end up with 90 new customers a year instead of 75. I've assumed the transactions per year stay at 2 because that's reasonably, reasonably high in terms of people coming twice a year. And you will have people who come more than that and people who come less than that. But let's assume 2, and I've said that doesn't change with the new numbers of people. However, what I have said there is that our nightly 2-night rate, we increased by $5. $5. Doesn't seem a lot, does it? And what I've done there is I've said, because we're trying to get a few more people in through our leads and we're trying to retain some people, we've spent a few more dollars in our expenses. So instead of $205,000, we've actually increased our expenses to $210,000. So our costs have gone up. So the old net profit, if we look up here, is $200,000 a year, which at a 5 times multiple, again that's low for some of your buildings, gives us $1 million value of our business. Now, through all of these things that we've done here, we've got 25 retained customers more. We've got 15 new customers, and all of these customers are spending an extra $5 a night, $5 per 2-night stay, $2.50 a night more. Anyone want to guess how much our profit goes up by with those numbers? No one wants to guess? Okay. Our profit increases by almost $36,000. Now you multiply that by 5 and it increases our business value by $180,000. Now all we did was we kept 25 more customers than the year before. We got 15 new customers and the price went up by $5 for a 2-night stay. And that's made a business improvement of $180,000. Does anyone think they might be able to do something like that in their business?
Can I ask, why did you multiply by 5?
Because that's your multiplier when you sell your management rights business on the market. So for those of you who may not be aware, when we sell these businesses, it's a multiple of our profit. So you can see the profit there is $200,000, we multiply it by 5, and obviously our business valuation is a result of that. Now again, I haven't moved the multiplier. I've used 5 for this multiple here. That multiple might go up or it might go down. Typically over the industry lifespan that I've been involved, it has gone up other than around the GFC time, where we had a little bit of a retraction. When I first came into the industry, and I'm probably in the room the second oldest, not in age, but in terms of length of time in the industry. Dave Ruxton, who's a life member of REI, is sitting over here, is one of my clients. I know Dave got into the industry in the early 80s. I got into the industry in 1988 and Dave was already well established at that time. But the multiple when I got into the industry was between 2.5 and 3 times multiple. And we see where it is today. 5.5 plus, some buildings selling for over 6 times multiple. So this is what I'm trying to get you to understand, is using the business drivers that you have available to you in your business to improve the business. I have a number of clients who do a lot of this stuff. They've got spreadsheets, they analyse them monthly, weekly in some cases, and they measure these figures. If you're not measuring these figures, how do you know what you need to improve in your business? So I'll leave this slide on that thought. Oh, hang on, sorry. Okay, so I'm now going to discuss the permanent side of this growth equation. So I've got 2 different slides there. The last one was obviously holiday short term. This one's for our permanent people in the room. So let's say we've got existing customers of 100. So we've got 100 people, tenants, in our complex. And we retain 85% of them every year. 15% of them move on for one reason or another. Again, if we have leads and inquiries, and obviously there'd be a lot more than that in the current environment, but for this I've just said 30 leads when you get one room, one apartment that comes up for rent, and obviously we convert 50% of those into new clients. So we've got 15 new clients a year. So you'll notice the 15 and the 85 give us 100, because obviously we've got 100 rooms to fill. And then once we actually have a tweak in the retention rate, we keep 95% of those 95, and you'll see down below the leads come to 5. Now that's a much more easily managed business. I do know of managers that don't like that sort of scenario because they want letting fees coming through and new lets. So they'll either A, control that by keeping 6-month leases and hoping more of them leave at the 6-month period, and obviously getting more let fees. Now obviously that's great for your business model, it's not as great for your owners, but obviously it depends on the business model you're running. As Justin said, our main aim is to keep our assets, our owners being one of them, happy, and we're working in partnership with them. So the second scenario there, where we've actually got a higher retention rate of tenants, means typically less wear and tear on our apartments for our owners. Typically means we've got a good tenant that wants to stay. Those sorts of things will typically flow with that scenario. So what I've done there is I've said previously we had 50 transactions a year. Now I've said that because let's assume we've got some people moving in and out. We've got a couple of week crossover period because of one reason or another. We're not as efficient with our time, and we haven't got people sort of moving in one day after the other. We've only got 50 transactions per year. In the bottom one I've said 51 transactions per year. You'll see in the blue box just here, $500 rent, $7.50 a month admin fee, 1 letting fee per year, and 1 week rent at 7.5% is our commission rate, commission and management fees. So that gives us in commission and management fees, and I've brought all of the other charges back to a weekly rate so that I could get this number right for an average transaction per week of $48.85. That's what we get off one apartment when those are our charges. So we're getting that 100 times, aren't we? Because we've got 100 rooms that are staying at $48.85 per week. So we're getting that 100 times every week. In the green below, I've just increased the rent by $10 a week. I've increased the admin fee by $1 a month. And I've increased the letting fee from 1 letting fee per year to 1.25 letting fees per year, obviously suggesting that we're turning our tenants over a little bit more. And I've left the commission at 7.5%. So in that situation, our average transaction goes from $48.85 to $52.47. So it's only $4, not quite $4, $3.50 difference. Now, what we can see, I've left the expenses the same down the bottom there at $40,000 each for this complex. So what we can see is the net profit up there was $204,250, which was a valuation at 5 times multiple of $1,021,250. So again, by tweaking and honing all of these business drivers, we can see that we've increased our profit by $23,000 and our business valuation by $116,000. Now again, if you don't know these numbers in your business, how do you expect to improve them? Okay? So you need to understand what drives your business, where the profit comes from, and how to improve it. How does this tie into bundling? I'll tie that together in a minute. Okay, so I'm just going to get out of that screen and back into the presentation. Okay, so your business and your obligations, obviously many of you will have structures in your business. Trusts, companies, larger partnerships, you may be involved in a syndicate, or smaller partnerships where it's just a mum and dad partnership. Just be aware, obviously you have obligations as a business owner, and typically those obligations, and I went back to the Corporations Act and had a look at that last night in preparation for today, looking at your obligations as business owners. You have an obligation to manage the corporation. Many of you are mum and dad business owners, and the business is considered to be you. Now, at law, the business is its own entity. It sits there as its own legal entity, as its own operation. You, as a shareholder, as a manager of that business, obviously operate the business for the benefit of the shareholders typically. In a lot of cases, same people. Okay? You've got an obligation to manage the corporation and a duty to trade to make a profit for the shareholders. So there's actually specific sections in the Corporations Act that talks about operating a company other than for profit. And if you're intentionally doing that, I don't know why, but obviously there is connotations and laws that get broken if that's the case. So just reminding everyone, obviously we've got this business, we've got the key drivers of the business, we've got an obligation to make a profit. Obviously we need to then consider the best way to manage that business. Okay, that's when we start to talk about bundling versus unbundling, because we need to make a decision on how we manage our business the best. Now again, I'm not going to be saying that, you know, the bundling is wrong. I've got clients that are bundled. My preference is unbundling, and I will explain why in the next few slides. So what is bundling? Bundling is sold as an innovative way to charge for your services to your unit owners. It's said to replace a long list of individual charges, particularly in short-term letting. Typically, the bundled charge will be expressed as 1% of the revenue earned by the unit owner. It will be shown as one line item on your owner's statement, typically, the things that are bundled. Okay? As an example, the old way of doing things, you would have commission 12%. I'm not dealing with GST here, these are net figures. Advertising 3%, credit card charges 2%, Foxtel, PABX, room supplies, spring cleaning, admin, all these different charges that you would charge your owners. They would all show up on owner statements when they're charged. Very transparent, because the owners see everything that we're charging them for. Sometimes that will create a telephone conversation because the owners want to know what something is because they can see it there. By looking at these charges annually and your revenue, you can calculate what the annual charges will represent as a percentage of your property revenue. So it may be something like 25% of your property revenue on your owner's statement. Then this is shown as one line charge for bundled services. However, those charges that I mentioned in the previous slide didn't include cleaning and linen. Now, cleaning and linen are a big one, which is obviously variable, and repairs and maintenance is the other one, which is very variable. So when I say there it may be 25% of the total, that would typically be if you're excluding repairs and maintenance, cleaning and linen. Typically, cleaning and linen, given their nature, is tied to the visits of the guests that come into your apartments. Hence, a variable charge, it is harder or more difficult to bundle and get right in terms of your calculation. So if you bundle these charges, including cleaning and linen, but excluding repairs and maintenance, because that is truly variable, I personally would say to you, if you try and bundle repairs and maintenance, you're crazy. Because obviously you can have something that is very large pop up and be unforeseen. So typically repairs and maintenance is left out of this, but let's look at everything else. If we chose to bundle, typically we would end up somewhere between 45 and 55%, including GST. So the monthly statement would go from all of the various charges that we're charging the owner to something looking like this. Revenue from bookings or rent, $3,000. Management charge, $1,500, which is, I'm assuming, 50% including the GST. Repairs and maintenance of $500. Payment to the owner, $1,000. So it's a very simple model in terms of the owner statement that the owners get. Looks simple, doesn't it? The selling points are obviously the simplicity, one charge, not many charges, and that the unit owners are happier because they don't seem to be getting all these charges as one line item. They're aware of what the percentage is. They can always understand that. And obviously a lot of people who are advocates for bundling say you're in partnership with the owners, because when your occupancy goes up, when the occupancy goes up in their apartment, they win, you win, etc. So it tends to be a simple situation. However, bundling typically gives an added bonus, and some factions in the industry, in the management rights industry, are not happy with this component. So if you bundle an advertising levy and credit card typically as well, and I'll explain credit cards in more detail in a moment, you can Not saying you will, but you can come up with a one-off profit if you bundled, stayed for 6 months, 12 months, and then sold your business. Because an advertising profit, if you're not expending all of your advertising revenue, can end up being bundled into your profit, whereas when you unbundle, the advertising profit typically is netted against the income to give a zero profit figure. Credit card uncertainty is the other issue, because if you bundle and you get rid of credit card fees, you fall outside of the legislation that obviously deals with credit cards. There was some uncertainty around that last year. I was instrumental in organising a forum in November between all the accountants, lawyers, agents, valuers in the industry. There was 69 people showed up out at Arundel Golf Club for a seminar, and we sat there and we nutted through it. It was always my firm opinion that people who charge the owner for credit card fees, not the guest, don't have a problem with the legislation that was released last year. They could continue making a profit. And I've sought a large number of legal opinions, and it typically has been accepted that you can continue making a profit on advertising where you do not charge the guest directly. So if you're charging the owner, not a problem. If you're charging the guest, there is a problem and you can't make a profit. 99% of my clients and of the industry typically charge the owner. I do have one client in the room who doesn't, but in terms of that, you just have to pare back your profit on that margin to your costs. Unfortunately, my suggestion to those people who are charging the guests is look at another way to recoup that revenue, whether it be a booking fee or some other type of charge, because you are losing revenue. Now, by bundling, obviously those things disappear into the bundled amount, so it's very hard to understand where the profit on those things is, so how do we add it back at sale time? However, the banks have started putting pressure on the industry over this issue of bundling. I'll refer to this a bit later because it's a little bit more of an in-depth conversation, but those two issues are predominantly the reasons the banks have got problems with bundling. And I'll address that more in a moment. So what's the opposite of bundling? Unbundling is a traditional way of doing business. Charges are separately noted on your POA forms, such as commissions at 12%, advertising, etc. All these things I mentioned before. So they are separated in your POA form. Under a bundled arrangement, which Tony will talk about in depth tomorrow, they're not as separated, you've just got a percentage. And it says all of these things are included. Now, in terms of our growth equation that we spoke about before, obviously, if we're trying to maximise our profit, we need to understand all of these numbers, but we also need to be able to see what profit do we make out of our cleaning, what profit do we make out of our linen, what profit are we making out of our tours, what profit are we making out of our credit cards. All of our profit centres need to be understood so that we can manage our business to the best of our ability and use this growth equation to drive the value of our business forward. Okay? So, I'm actually, it's a little bit small to read. Can you guys up down the back see this? Justin's going to come and show me some whiz-bang way of improving that. There we go, Zoom, the Zoom function. Thanks, mate. I'm a numbers man. Okay, so what we've got here is an excerpt of a particular business that shall remain nameless. Obviously, we've got our body corporate remuneration and we've got our commissions on the holiday business there. You can see there the advertising profit is zeroed out, so the income and the expenses are, this was prepared for a refinance with a bank, these figures. You've got your agent's commissions less the agent's expense. We've actually made a profit in there, a nice profit in there. Then we've got our cleaning, our linen, and obviously our incidental costs, our wages for our cleaning. We've got our linen expenses and our consumables in there. All the while you can see we've got percentages there, and we're looking at what those percentages are and what they're likely to achieve for our business. This is where our profit undertaking is coming from. Credit card income and expense, and our margins, hire of televisions, beds, cots, etc., and our cost. Many of my clients own their own TVs, rollaway beds and cots, so that cost is lower. They'll go and buy those so that they can have a lower expense there, and obviously it pays for itself when you get the multiple on that profit. Body corporate outlays, dry cleaning, tours, that tour expense there is way under what it should be. I talked to that particular manager and said to him, listen, we need to get that further towards between 12 and 15%, which is where that margin should be. If I go back to cleaning and linen, obviously 50% is a pass mark. Those of my clients who are in the room have heard me say this before, 50% is a pass mark. You should be getting 50% or better out of your cleaning and linen. The better operators are getting closer to 60% margin out of that. Credit card charges typically will be between 30 and 60%. So this particular person is on the lower end of that scale. So I can sit there with my clients in an unbundled situation, have meaningful conversations about their margins and where their profit's coming from and what they need to improve on. Now, in many situations, and I've got one great example, a client of mine who is the nicest human beings in the world, they will not increase the charges to the owners. They've been in the building for 14 or 15 years. The owners are still paying the same charges they were 14 or 15 years ago. The tariffs to the guests are 15 years old because they don't want to tell these lovely people who come and stay with them for 6 weeks that they're paying, too little. The reason that they come for 6 weeks might be that they're paying so little. They don't want to have awkward conversations. I've said to them, they want to retire now. I've done some figures for them, we've had these conversations, and I've said to them, guys, if you retire, you're not going to achieve what you want to achieve in this business because your rates are 15 years old. And it's not the first time I've had this conversation, by the way. It didn't sit there for 15 years and suddenly we had the conversation. We have it a couple of times every year. But they were just too nice and they didn't want to get out of their comfort zone. Wonderful building, wonderful location, should be a cracking business, is an average business. It's great for someone who might want to buy it, but obviously for these people who are looking to retire, not ideal. The conversations are more difficult if all of these costs and income items are bundled together. Can you understand where I'm coming from? Okay. So you can see there all of the various profit centres of the business split, and that's allowed to happen in our financial statements because we unbundle. Yeah.
If you've been there, like a few years, and you've been keeping all the records just up to date, you should be able to work out percentages based on what it was on the non-bundling to the bundling, and then entering it into your system as a percentage of the income that you were taking, and therefore you would be able to work out
a much harder road to try and do that, because the lines get blurred at the start, absolutely. But then as time marches on and things change, obviously your costs go up, things vary over time. You're not able to keep a handle on where they've gone as well as an unbundled model. Okay? So I firmly believe that, and I've seen it in various businesses where people have, and I've got some other reasons in a moment to talk about, this isn't the only one, but certainly I understand your point, and you can work that out, but again, it's going to take a lot more work and effort than being unbundled. So business analysis is what we've just been speaking about. It allows for a better business management with profit centres and monitoring of those profit centres. Unit owners will have less issues with transparency, in my view, with an unbundled model, because they see what you're charging them. So in many cases, if the owners have come from unbundled into bundled, obviously, and they're in favour of it, you're not going to have any issues. Generally speaking, it'll be you have a new owner come into the letting pool and they see this, and they've been used to it somewhere else perhaps, or it's their first foray into investment, and they've come into a bundled model. They're going to be asking all sorts of, well, how much does this represent, and how much does that represent, and it's going to be more of an issue. Getting it wrong. Now, this is my big concern with bundling, is getting the costs wrong can be very costly. When occupancy is high and growing, bundling can represent a better outcome in the short term, but obviously in the low occupancy periods it will give you a lesser result. So managing your cash flow needs to be very prominent if you are going into a bundled model versus an unbundled model. I'm an advocate for having budgets and obviously understanding your cash flow in any case, but more important in bundling versus unbundling. The other thing is, if you're in an unbundled arrangement and you go to bundling and you've still got some owners that are on the old PAMD 20A forms, as soon as you change the way you charge, you can't keep your PAMD 20A forms anymore. They have to all be replaced by POAs. So you have to go through the process of new agreements, which can be a pain in the neck. So just be aware of that. They all will need to be re-signed. Because you're refreshing the charges on the PAMD, the legislation makes you now go and get the new POA forms. Which is great, I've got no issue with that. Certainly new POA forms should be sought over time, but just be aware it's a pain in the neck to have to do them all in one go. Now, I mentioned before about the banks. One big reason to remain unbundled is that the big four banks hate bundling. I can't say it any clearer than that. They've said in a recent open forum to the lenders of the management rights industry who have fed the information back to us, that they will be looking at changing the way they finance bundled buildings versus unbundled buildings. They are saying that 3 years verified financials may be required. Sorry, I've said unbundled buildings, that should read bundled buildings. 3 years verified financials for bundled buildings. They will consider not offering interest-only arrangements to bundled buildings, and they will. They've also said that they want to see the profit made in advertising and credit card charges in bundled buildings, which can be almost impossible when there's no more charge for those things, it's all bundled. So you then have to assume what a charge might be to actually give the banks what they're asking for there. So they see bundling as more of a risk, mainly, as I've mentioned, in the business management of your business, because of the transparency of the profit centres is not as obvious. So I've given you a bit to think about today, obviously in terms of bundling and unbundling. I'm more than happy to answer questions from the floor. If anyone has questions to ask, Justin's got one. Yeah, sure. So Justin's got a mic, just raise your hands in the air and we can deal with your questions.
What about if I kick it off, Damien?
Sure.
What do you see as the biggest, it's on screen. What do you see as the biggest factor that could change in the next 2 to 3 years that could impact on to bundle or not bundle?
I guess technology would be a big one. Advances in technology can change rapidly, can improve the business. I know there's things such as the payment gateways that are starting to open up that you've mentioned to me before, where people are going to be able to basically pay and immediately the money be in your trust account and cleared funds. There's all different sorts of things that are going to improve this industry. I think the systemising, and again we spoke about this morning, the systemising of marketing, because marketing can be as uncomplex or as complex as you'd like to make it, and the larger buildings who have got more resources have more ability to throw time and effort and money at marketing. I think systemisation of marketing could vastly change the industry for the smaller to medium short-term buildings. I think obviously the IP and availability of information is getting better for managers. So the quality of managers, and I'm sure Dave, who's been in the industry for a while, would know since 1980 till now, the information that's been available to managers is unsurpassed now, with the way the internet is and the information online and everything else. Plus organisations like yourself, Justin, with REI Master and EasyRes, the information to managers is very, very good now. So I think managers are coming into the industry a lot more educated than ever before. So to answer your question, I've sort of said a number of things there, but I think technology is probably the overarching thing that can improve the industry.
And just on the back of that, what's the general feeling about the growth in wages and the growth in tariffs in particular? Is there any kind of feeling that they'll be aligned? And if they are or aren't, how does that affect the decision to bundle or not bundle?
Good question. I would suggest that we've been in a very low CPI situation in the current times, and that has meant that revenue growth has certainly not been huge. We've been very lucky in the management rights industry on the Gold Coast since the GFC in that occupancies have grown, the multiplier has grown, and revenue has grown as a result of the industry being in this current period of time between GFC and Commonwealth Games. Certainly there's been a spotlight on the Gold Coast, numbers of people have been increasing. I'm not talking so much about overseas people, but overseas and predominantly local people. Our local traffic has increased. I've seen in a number of my buildings steady growth in revenue over the last 3-4 years. So to come back to your question, obviously wages have been increasing, and we need to make sure that wages and revenue stay in check in terms of the percentage one against the other, because it can have a dramatic effect on your bundling, because if occupancy is flat, your percentage of revenue is flat. you don't have, you know, it's going to be a harder conversation to have to increase the overall percentage of bundling to an owner than it is to increase your cleaning or your linen. Because you're talking about so many more charges that you're increasing versus one or two perhaps. So in my view, keeping wages in check is very relevant to our revenue line, because if we've got wage growth and we've got a flat period of occupancy, it can really impact on the profitability of your business. Anyone else? Yeah.
Yeah. I'm just a bit interested in the, you mentioned about credit card charges.
Yes.
And we're under the belief, maybe it's a false belief at our place, that we had to not make any profit out of our credit card charges, even though the owner pays for it. It seemed to be your saying that we can make profit.
Absolutely.
We've been probably losing over the last few months because we've stopped taking that percentage.
Yes. So there's a little bit, that's why we had this forum of accountants and industry specialists to discuss this issue back in November, because obviously the legislation came into place in September. Now the issue is that the legislation was introduced to protect the owner of the credit card. So if you read that legislation, it talks about charging the owner of the credit card, and you cannot make a profit where you charge the owner of the credit card. I'd spoken to 3 or 4 industry specialist lawyers who are very instrumental in enacting legislation or on various government committees, etc. And we had an in-depth conversation about this issue, and I said, hang on a minute, that legislation is aimed at the owner of the credit card. I agree, if you charge the guest, you cannot make a profit on the credit card. You can recover your costs, but not more than that. However, where you charge the owner, it's a firm belief that the owner of the credit card is not impacted at all, because they're not paying for anything. So how then is that legislation covering the owner of the unit who isn't being charged a credit card charge? It might be called something similar on your POA or PAMD, but you're not charging them for using the credit card, which is what that legislation was made to protect the owner of the credit card. So the issue there is more around who's being charged and why are they being charged, and tying it back to the legislation that was enacted. I've looked at those issues. The lawyers that I've spoke to have looked at those issues, and we all firmly believe that if you charge the owner, you are entitled to make a profit in that profit centre, because it falls outside of the aims of that part of the legislation.
Thanks. Just another question.
Sure.
When you mentioned about the Form 6, and if you increase rates, you don't have to get a new Form 6 signed or change to Form 6 if it's an old...
Yeah, so I'll clarify what I said there. If you're on a PAMD form, still with your owner, and you increase your rates or change the schedule of charges, you cannot continue to use that same PAMD because it's been refreshed after the legislation has been enacted, making you then go and get a new POA. So you have to change your PAMD to POA then. That's the advice I've been given from solicitors.
So any increase
lawyers.
In rates, like a general increase in your cleaning rate, if you're on the old PAMD form, you have to change to Form 6.
It's my understanding, absolutely, yes.
So eventually everyone will have to go to Form 6 because you can't just maintain those rates.
Otherwise you can't increase your charges, yeah.
Yep.
Yep, that's my understanding.
If you're already on a Form 6.
If you're already on a Form 6, happy days. Yeah. Anyone else? Fire away. Oh, sorry, Justin's just going to bring you the mic.
Most of the conversation today has been about short-term letting. Do you have an opinion on the differences in bundling for permanent letting, where there are more fixed charges, less cost centres or income streams, what did you call them?
Profit centres.
Business drivers.
Yeah, business drivers.
Yeah.
Yeah, absolutely. I do take note that there are less business drivers, so to speak, in a permanent complex. And again, there are more fixed revenue streams. The same issues apply though, obviously. As I mentioned, if I just bring up the... sorry. Which one's that one? No, sorry, I've got the wrong one. Just give me a tick. So if I bring up the model here, which it relates to permanent, we've still got a number of business drivers. Obviously, our letting pool owners, our tenants, the number of transactions a year, they're all reasonably easy to control. However, being aware of these business drivers here, in terms of our charges and so forth, that's where we really need to focus our time. And you can do that bundled. So my view is bundling and unbundling in a permanent complex are probably closer in terms of the reasons why or why not than in a permanent complex. I think there's, in a holiday complex short term, there's more reasons why or why not to bundle versus unbundle in a short term let. However, my argument still in terms of the banks and those things are obviously still relevant. They are really not in favour of the bundling arrangements.
I think in relation to the permanents, we could all think about things like our guarding and maintenance that might be charged typically to the owners if that's included in the rent, the letting and relet fees, the spring clean and other types of fees that may be included on an annualised basis. And then perhaps one of the points I took from Damien today is regardless of what those expenses to the owner are, and whether you bundle or not bundle, do you have an understanding of the income versus the expense in your business? And if you do, you can make some quality decisions. Is that fair?
Yeah, absolutely. And as I say, the transparency is still there in terms of if you're in a permanent complex and you're looking at a bundled statement versus an unbundled statement versus a bundled statement, you can see, as Justin says, you can see all of the various charges and you can make decisions around those.
And I think Damien's spreadsheet here is a really good start. One of the things I was thinking up the back there is, okay, there's very much a focus on that spreadsheet about what the manager is in control of. The manager's in control of better acquisition, better retention, perhaps a slightly higher tariff, and the example Damien gave was a very small increase in tariff. And I think in consultation with your accountant, you could also have a think about the things that aren't in your control. A sudden spike in wages, duopoly that's emerging between Booking.com and Expedia, and what that means for commission amounts for OTAs, and how that can impact on your income, and depending on how your business is set up to charge commission on gross or net amounts, and all of those kinds of things. And what Damien's presentation today got me thinking about was, can I use the available figures to make the right decision? Can I analyse it right? And I guess whether you bundle or not bundle, that same logic applies.
It does, and a further point to what you're making there is, when you're looking at a marketing strategy, you need to look at the current makeup of your building. And again, I've sat with clients and some of them in this room, and we've looked and we've said, okay, well, we might have a higher percentage of agent bookings and less direct bookings. We might have a higher makeup of rental guarantee apartments versus letting pool apartments. How do we get the most out of our business over the period of our ownership of it? Do we need to move rental guarantee apartments out of rental guarantees into POA forms so that they're at a higher valuation for our business when we sell it? Do we need to consider the mix of our marketing and our guests and try and change that with more direct bookings perhaps, or a different marketing strategy? So there are various marketing consultants around the Gold Coast who specialise in this industry, and they take different approaches depending on what you're trying to achieve with your marketing. So what Justin says there about the wholesalers is absolutely valid, because I know, for instance, those wholesalers have got different wholesale rates in America than they do here. And it's only a matter of time before our rates here increase, and I think that's where Justin was headed with that part of the conversation. And so what can we do about that? Be less reliant on them. How do we then formulate a strategy to get people coming to us and reduce our agent bookings perhaps? So we're now getting out of a pure bundling conversation. We're getting into more of a business improvement conversation, and we're really saying, how do we improve our business? Because today this is where it is. Tomorrow we want it to be better, for whatever reason that might be. Typically so we make some money to enable ourselves to have a reasonable retirement. That's going to drive us to make decisions today about what happens in our business tomorrow.
So another one that I had for you is, let's say your complex was big enough to warrant sort of some A/B testing. In marketing we might send out email A versus email B and see what kind of response rate we get. If there's some owners who are willing, and you're currently not on bundling, would it be a strategy to have a number of owners on one type of strategy versus on a traditional strategy, and then do some analysis like that? Or is the case so strong against bundling that we shouldn't go there anyway?
Yeah, that's a great question. Geez, you're coming up with some good ones, mate. In terms of my view, I'm an advocate for remaining unbundled for the reasons that I've said today, particularly for short-term letting. But in what you've just said, Justin, obviously you could consider doing that. It's going to take some admin burden, I guess, to run both. But it could be done, that's for sure, if you wanted to dip your toe in the water. Obviously it would take some consultation with your software providers to enable the system to do what you want it to do, but I know it can be done, as you would know.
Yeah. Okay, does that prompt anyone else to fire off some questions? Okay, so everyone's got Damien's contact details, and I know that he's really receptive to any questions that people might have. I think what that does is it gives us one side of the story, and we're really grateful for Tony for coming tomorrow to present his point of view. And as we've seen, that Damien's got some pretty compelling reasons why his point of view is the one to follow. So it'll be great to see Tony tomorrow. I know that Damien will hang around at the end for anyone that wants to pick his brain. Also understand that many people being out of your business is a big deal, and if you need to just leave, that's totally fine. I'd like to take the opportunity to thank Damien for giving up his time. So thanks very much, Damien.
Thank you. Thank you.
All right, great. So for those of you that are coming again tomorrow, I look forward to seeing you then, and thanks for coming today.
Thanks, guys.